So imagine upgrading a machine, right? Like you're putting in the absolute most advanced parts in the world for 15 straight years.
Okay.
You swap out the old components, you streamline the aerodynamics, you make it lighter and even cheaper to run.
Right. Sounds good so far.
Yeah, but then you take it out on the highway and you watch his top speed drop by like 20 miles an hour.
Which just, I mean, that completely defies the basic logic of progress.
Yeah.
When an industry gets modernized, performance is supposed to improve.
Exactly. And today we are looking at the exact financial equivalent of that paradox. So, welcome to the final verdict of our three-part deep dive.
Yeah, we made it.
Over the last two discussions, we've been unpacking that legendary 2010 finance paper by Fama and French, where they basically took a microscope to the active mutual fund industry.
Right. They built this massive analytical machine to test for true, genuine stock-picking skill.
And our mission today is to answer one massive question for you. What happens when you take that exact same analytical machine and you feed it 15 extra years of data?
Bringing us all the way up to 2025.
Yes. But before we get to the new data, let's do a really quick 60-second recap for anyone just catching up.
Good idea. So, Fama and French originally found that after fees, what we call net alpha, the average active manager was performing worse than pure luck.
Right.
But before fees, their gross alpha, historically, that looked exactly like a coin flip.
Like zero, basically.
Yeah, it hovered right around zero, about 0.21%.
And we also established that the true skill standard deviation in the industry is about 1.25% per year.
Right, the magic number.
Which essentially means this entire sector is mostly just statistical noise. I mean, you have a tiny, nearly invisible handful of real stars, a few real losers, and then just a massive middle ground of people experiencing variance.
Yeah, luck. And that was the definitive state of the world when the original data ended back in September 2006.
But then we turned the crank on the next 15 years of data.
And the story got significantly darker.
Yeah, it really did. It got worse in a way that goes far beyond what anyone expected. And it all revolves around one specific phrase that we're going to use as our mantra today.
Here we go.
4,523 to 2,538.
4,523 to 2,538.
By the end of this deep dive, you will know exactly what those numbers mean and why they basically rewrite the rules for your own portfolio.
I think, honestly, the clearest way to understand the darkness is just to start with a top-line truth.
Lay it on us.
The net alpha didn't just stay historically bad. The bottom completely fell out.
Yeah, so if you're picturing this right, if you plot the entire industry on a bell curve, the whole mass of the industry hasn't just like flattened out. It has physically slid backward into the red.
Exactly. Let's put the actual measurements to that shit. So we're looking at the value-weighted net three-factor alpha.
Which, just to clarify, think of this as how the representative dollar invested in active U.S. equities actually performed against a standard benchmark.
Right. And in the original 1984 to 2006 sample, that number sat at negative 0.67% per year.
Which was a negative point estimate, but mathematically it was borderline.
Yeah, the t-statistic was negative 1.67.
Meaning there was still like a tiny sliver of statistical doubt about whether it was definitively a negative trend or just a bad run of luck.
But when we extend this sample from 1984 all the way to 2025, that average drops to negative 0.92% per year.
Wow.
And the t-statistic plummets to negative 3.25.
So translating that out of the statistics textbook, the underperformance is now so severe that the chance of it being a random fluke is, what, less than 0.1%?
Exactly. It is definitively fundamentally significant.
Okay, but let's look at just the modern era.
Yeah, if you isolate just the post-2006 era, the floor completely gives way, negative 1.32% per year.
It's like we checked a leaky bucket 15 years later, expecting someone to have patched it, but the hole actually got bigger.
The representative dollar in active U.S. equity is unequivocally bleeding value against the benchmark.
Okay, let's unpack this, because it's not that the managers got lazier, right? It's like they've been training for 15 years, they bought lighter running shoes, but the market treadmill they're running on just cranked up from 5 miles an hour to 15.
That treadmill analogy is perfect, actually.
Yeah.
It brings us to the most perplexing part of this data set.
Yeah.
Because we really have to talk about the cost of those running shoes.
Wait, yeah, this is where the logic completely fractures for me. How did performance get so much worse when we all know that over the last 2 decades, the cost of investing has plummeted?
It has. The fee compression has been massive.
Right.
Between 2006 and 2025, value-weighted expenses, where the actual bulk of investor money is sitting, dropped from 0.92% down to 0.74%.
Okay.
And on an equal-weighted basis, so counting every fund equally regardless of size, it dropped from 1.33% to 0.94%.
I mean, Jack Bogle would be thrilled. That is nearly a 30% drop in fees across the board.
It's huge. The industry got dramatically cheaper.
But mathematically, right? If the fees drop by roughly 20 basis points, the investor's take-home return should go up.
You would think so.
So the only way net returns go down when fees go down is if the manager's raw, underlying stock-picking skill completely fell off a cliff.
What's fascinating here is that is the real bombshell of the extended data.
Yeah.
It's the headline finding that goes completely beyond what the original researchers could have seen in 2010. The gross alpha, the raw stock-picking skill before a single cent in fees is shifted decidedly negative.
Let me just repeat that because it rewrites the entire narrative. In the original 1984 to 2006 sample, the value-weighted gross alpha was 0.21%.
Right.
That was the era of pure luck. They weren't adding value, but they weren't actively destroying it before fees either.
But step into the post-2006 world. The value-weighted gross three-factor alpha is negative 0.54% per year.
Oh, man.
And the equal-weighted gross four-factor alpha is negative 0.66% per year.
Okay, I am going to play the skeptic and push back on this just a bit.
Yeah.
Because a careful statistician looking at these numbers would flag something. You're giving me a point estimate of negative 0.54%, but the t-statistic on that is, what, negative 1.36?
Correct.
That hasn't crossed the conventional threshold for statistical certainty in an aggregate portfolio test.
That's true.
So if it's borderline, are we overstating this by calling it a bombshell?
Well, if we only relied on that one aggregate test, yes, we would have to temper our language. We'd say it's an economically meaningful trend, but not a proven absolute.
Right.
However, we don't have to rely on just that one test. We have the cross-sectional bootstrap.
Okay, let me see if I have the mechanics of this right, because this part is amazing. A bootstrap simulation is where we basically strip out all the actual stock-picking decisions made by the humans.
Yep.
We take the raw market returns and we shuffle them randomly. We create like 10,000 alternate universes of pure, unadulterated luck.
Exactly.
10,000 universes where monkeys are essentially throwing darts at the stock pages.
That is the exact mechanism. You build a massive simulated population of coin flippers representing a universe where exactly zero skill exists.
Okay.
And then you lay the actual performance distribution of the human fund managers over that baseline.
And what happens when we compare the Ivy League MBAs to the 10,000 universes of monkeys?
It's brutal. When we run that bootstrap on the post-2006 gross returns, every single percentile of the actual human data sits to the left of the luck distribution.
Every single one.
Not just the worst performers at the tail end, every single percentile. And between 3 and 10% of those random luck-only bootstrap universes fall entirely below the actual data.
Wow. So even if the single aggregate point estimate is technically borderline, the entire shape of the industry is fundamentally underperforming random chance.
The null hypothesis of zero skill is clearly rejected.
The average active manager is now actively destroying value before costs are even factored in.
Literally, a room full of coin flippers would beat the active management industry before costs.
Which brings up the million-dollar question, why? I mean, how does an industry flush with infinite computing power, AI, and the smartest analysts in the world get objectively worse at their core job?
The leading hypothesis is exactly what your treadmill analogy suggested earlier. The markets simply got more efficient faster than the managers got cheaper.
Right.
Think about the structural changes since 2006. High-frequency trading, algorithmic indexers, instant information dissemination, it completely altered the landscape.
The easy margins are just gone.
Exactly. You have tens of thousands of brilliant analysts looking at the exact same data feeds, running the exact same factor models.
Yeah.
And you have incredibly cheap passive index products pricing in those easy factor premiums almost instantly.
So if a manager wants to justify their fee, they can't just buy a basket of like slightly undervalued small cap stocks.
No, the algorithm already did that milliseconds ago.
Right. So they have to make weird, highly concentrated, idiosyncratic bets.
And idiosyncratic bets, by definition, have zero expected alpha. The more they reach for returns to stand out, the more they stumble.
Quantitative finance is essentially eating its own dinner.
Perfectly said.
Okay. But if the humans look this bad against the baseline, maybe we're judging them against an unfair benchmark. I mean, finance didn't stop evolving in 2010.
Sure.
Fama and French actually updated their own model in 2015, right? They added profitability and investment factors to create a five-factor model.
We did.
So if we upgrade the benchmark to the absolute state-of-the-art, a model designed to capture the exact modern premiums these managers might be targeting, does that rescue them?
No. The data is incredibly clear on this.
Not at all.
If we look at the model comparison data, the value-weighted net five-factor post-2006 alpha is negative 1.24%.
Ouch.
The underperformance is just as statistically certain. The T statistic is negative 3.11.
So the benchmark is perfectly fair. The managers just simply don't beat it.
They don't. And this brings us to another highly revealing layer of the data. Because this underperformance isn't perfectly smooth year over year.
Right.
There are eras where the entire industry gets it spectacularly wrong.
Here's where it gets really interesting, because if I asked someone on the street to guess the worst decade for professional stock pickers, they'd almost certainly say, like, the 2008 financial crisis.
Or maybe the violent market swings during the 2020 pandemic.
Right. But the data point's somewhere entirely different. Bring out the drum roll for the absolute cruelest decade for active management. The 1994 to 2003 dot-com boom and bust.
The wealth destruction in that specific decade is staggering.
Give us the numbers.
The equal-weighted net four-factor alpha was negative 2.33% per year.
Jeez.
And just to put that in context, the decade prior to that, from 1984 to 1993, the alpha was just negative 0.17%.
Negative 2.33% per year, sustained for an entire decade. How does an industry of highly paid professionals collectively mess up that badly?
You really have to picture the pressure an active manager was under in, say, 1998 or 1999.
Okay.
Your benchmark is absolutely skyrocketing because of absurd tech valuations. Companies with no revenue are doubling in market cap every month.
Right, the pets.com era.
Exactly. So if you sit on the sidelines acting like a prudent, fundamentally driven value investor, you look incredibly foolish to your clients.
You're lagging the index by double digits, and your clients are pulling their money to go to the fund next door that's just blindly buying Cisco and Sun Microsystems.
So eventually you cave. The active managers chase the bubble late. They loaded up on soaring tech stocks right as valuations were peaking, basically just to keep up with the index.
So they were late to the party on the way up?
Right. And then, when the bubble inevitably burst, the pain was so severe, the very clients who forced them into those risky positions panicked.
Of course they did.
Massive redemptions forced managers to liquidate those positions at the absolute bottom, getting fired right around 2001 and 2002.
Literally just before the market actually started to recover.
Exactly.
So they got the decade exactly wrong on both sides. They bought at the top out of peer pressure and sold at the bottom out of panic.
And because we're measuring cross-sectional alpha, that kind of massive collective mispositioning across the whole industry shows up as a catastrophic destruction of value.
Which, I mean, raises an existential question for the entire field. If the performance is this deeply negative and whole decades can destroy that much value, how does this industry even physically exist in its current form today?
That brings us perfectly back to our mantra for today.
Yes. 4,523 to 2,538. I told you we'd come back to it.
We have to look at the fund mortality data. The industry actually peaked in 2008, right around the financial crisis, with 4,523 active U.S. diversified equity mutual funds.
Okay.
Fast forward to 2025, and that number has plummeted to 2,538.
A full quarter of the entire industry just vanished. Roughly 2,000 funds were liquidated or merged out of existence.
Yes.
But the underlying capital didn't just vanish, did it?
No, the industry rapidly consolidated. The surviving funds basically absorbed the capital of the funds that died.
Right.
The average assets under management for a surviving fund skyrocketed from about $989 million in 2008 to over $3 billion in 2025.
Let me just make sure the gravity of that is clear. The funds that survived are massive behemoths. They have incredible economies of scale. They charge lower fees, as we established earlier, and yet, as a group, they lose more to the benchmark than ever before.
It's the ultimate paradox of scale in finance.
Yeah.
They got bigger and cheaper, but the market got harder faster than they could adapt.
Okay, I have to push back one last time, mostly on behalf of every investor listening who thinks they have the golden touch.
Go for it.
Sure, the average manager is bad, the aggregate numbers are grim, the industry is shrinking.
Yeah.
But what if I just ignore the averages? What if I look at who crushed the market last year and I just put my money with that specific star manager? I mean, someone has to be the outlier.
It is the most persistent psychological trap in investing. And the data delivers an absolute persistence gut punch.
Let's hear it.
We tested this by looking at the year-to-year correlation of an individual fund's alpha.
Okay.
If a manager is truly skilled, and not just lucky, a good year should logically be followed by another good year.
Right. Skill is a persistent trait. LeBron James doesn't suddenly forget how to play basketball from one season to the next.
But in active fund management, the year-to-year correlation of a fund's alpha is essentially zero.
Zero.
We measured the Pearson correlation at 0.103. The Spearman rank correlation is 0.093.
A flat 0.1.
Basically.
To put that in perspective, that means last year's performance has virtually zero predictive power for next year.
None. Picking last year's top-performing fund gives you almost no statistical advantage over picking a fund at random. It's just throwing a dart.
And this circles perfectly back to that 1.25% standard deviation number we mentioned at the start of the series. If the true skill deviation is that incredibly narrow, then the vast majority of what we perceive as outperformance in any given year is just pure, unadulterated variance.
It's luck. And luck, by its very nature, does not persist.
Wow. So what does this all mean? We have journeyed through 3 deep dives, analyzing decades of data, tens of thousands of funds, and millions of simulated universes.
A lot to take in.
It is. But when you synthesize all of this, a very stark reality emerges. And to anchor this final realization, we look at the industry one last time. The active U.S. equity space went from 4,523 funds to 2,538.
If we connect this to the bigger picture, there's really a 5-point verdict here.
Okay, let's go through them.
First, Fama and French were right. Give them full credit. They built an analytical machine that perfectly diagnosed a fiercely efficient post-2006 world that they couldn't even see yet.
Their framework was bulletproof.
Absolutely.
Yeah.
Second, 1.25% is the magic number for true skill standard deviation. Mostly noise, very few stars. Third, fees eat skill for lunch. The average manager loses to the benchmark by exactly the amount of their fee.
Leaving nothing for the investor.
Exactly. Fourth, 15 more years of data made it worse, not better.
Which is still just so crazy to me.
And finally, fifth, gross alpha has shifted negative. The coin flipper now wins before fees are even paid.
If you're listening to this and thinking about your own retirement accounts, the single final image I want you to walk away with is that bell curve we talked about at the beginning.
The CDF comparison chart.
Yeah, that chart showing the entire mass of the active management industry sliding backward into negative territory despite dropping their fees. That is the one chart we wish every single 401k enrollment form included.
It really fundamentally changes how you see your portfolio.
It forces you to replace marketing narratives with cold, hard math.
It does.
But, it also leaves us with a deeply provocative structural paradox to ponder. We talked about the market treadmill speeding up, making it harder for these managers to survive. The industry has already consolidated, losing nearly 2,000 funds.
Right.
But at what point does the math become so punishing that it forces the remaining 2,538 funds out of existence entirely? And here's the real kicker to think about.
Okay.
If every single investor wakes up to this reality, abandons active management, and goes 100% passive,
Right.
who is left to actually do the fundamental research and set the prices of the stocks?
Oh, wow. Yeah. It is the ultimate looming koan for modern finance. If the active managers all die off, the passive indexers are basically flying blind.
So I encourage you to look at your own portfolio today with this new, significantly darker reality in mind. Are you paying someone a premium to run on a treadmill they just keep falling off of? Thanks for taking this deep dive with us.